All right, thanks for joining us for part two of a brief discussion on inflation. I'm Brandon Kutz, a partner and multi-asset strategist here at Research Affiliates, and I'm joined today again by our founder and chairman, Rob Arnott. In part one of this discussion, Rob put recent inflation prints into historical context and walked us through both our cyclical and our secular views on inflation. In short, and while secular inflation may play out in either direction, Rob sees near-term inflation as the path of least resistance in the coming years, so don't be surprised to see that surprise to the upside. Now, on to the questions that I've got for Rob. Rob, do you feel as if the market has priced in the possibility of inflation surprises in the coming years, or do you think that inflation expectations need to rise further from today's levels?
The overwhelming consensus is that this inflation is transitory. One of my favorite economists, Savita Subramanian from B of A, in March of last year, coined an interesting expression. She said, we're going to see transitory hyperinflation. Inflation will rise to high single digits or perhaps even touch double digits, and then eventually will settle back down. But the key question is, will it settle back down to 2, like everyone hopes and expects? Or will it settle back down to 5, in which case inflation becomes a self-fulfilling prophecy as consumers change their behavior. Now, I'll note that the 10-year inflation expectations, defined by what's called break-even inflation, the difference between Treasury bond yields and TIPS, inflation-linked bond yields, it's called break-even inflation because it's the inflation rate at which the two different bonds have the same return. Break-even inflation today is ballpark of 2.5%. That's up from 0.5% in the 2020 lows. So inflation expectations have risen. But 2.5% is a far cry from the 7.5% inflation we saw in the 12 months ended January. And as noted in the previous taping, even that 7.5% is likely understated because a third of inflation is housing, is shelter, which has built-in smoothing and lags. So it understates when inflation is rising, it understates. As I mentioned previously, inflation expectations would need to rise another 80 basis points from today's levels and stay there for the next 3 years in order for the Fed to establish credibility with their 2% target that they established back in 2012, let alone to account for cyclical and secular tailwinds to inflation that seem to be on the horizon.
Okay, so Rob, let's assume that inflation is likely to continue to surprise to the upside, and that the market hasn't yet priced these dynamics in. If that's the case, what asset classes are most likely to benefit from this environment?
Well over a decade ago, we coined the expression third pillar for investing. First pillar is mainstream stocks, second pillar is mainstream bonds. Investors have those pillars covered. The third pillar would be diversifying markets that diversify risk away from mainstream stocks and bonds, and, unlike mainstream stocks and bonds, that provide a positive link with inflation shocks. Now, we've done some interesting work that measures each asset class for its return sensitivity to inflation, basically measured against inflation shocks. What's the rate of inflation against the previous inflation expectations? Going back to the early 70s, and with inflation surprise defined as the difference between realized and expected inflation, we measure each asset class's sensitivity to inflation, and it's pretty telling. For most conventional stock and bond markets have a negative beta to inflation surprise. Long treasuries have a beta of about -7, which means that if inflation surprises to the upside, treasury bond prices fall by 7% to the downside, magnifying the impact of inflation shocks. Commodities have a beta of +8. So if inflation surprises 1% to the upside, commodities rise 8%. It's a huge difference. What about portfolios of conventional assets? Mainstream stocks and mainstream bonds, near identical, a beta of -2. Inflation shocks 1% to the upside, then stocks and bonds perform 2% less than they would have otherwise. Now, if you put together an equally weighted portfolio of inflation-sensitive assets, third pillar markets, their inflation surprise beta is just over 1, meaning that rising inflation helps their return. A portfolio of diversifiers is not only an interesting option, it is an urgently needed option if you're of the opinion that inflation surprise regimes are likely in the coming years.
Okay, so I get it that these kind of inflation sensitive and diversifying asset classes naturally do better in inflation surprise regimes. But what about our own forecasting work? Does that corroborate the view that inflation sensitive markets are poised for superior returns in the coming years?
It does. Now, there's a lot of moving parts in the capital markets. There's relative valuation, there's the macroeconomic backdrop, there's the inflation backdrop. And while we've been talking about inflation sensitivity of asset classes, relative valuation is actually the 800-pound gorilla. If you start at an expensive starting point, your forward-looking returns will be mediocre at best. If you start with a market that's cheap, your forward-looking returns are likely to be very good. We have a website called Asset Allocation Interactive that provides forecasts for future 10-year returns for 130 different markets. And what's interesting is that the inflation-sensitive markets, the third pillar markets, are generally, with a few exceptions, priced cheap relative to history, and therefore are likely to provide superior returns even if we don't enter a period of sustained higher inflation. What about where most people have most of their money? Mainstream US stocks and bonds? Well, they're both priced to give you about a 2% return over the next 10 years. Now, that number is shocking to most people. It's not even matching inflation, meaning a negative real return. It's beyond the scope of this discussion to go through the math of where we come up with these numbers. But if your mainstream portfolio is likely to be vulnerable to inflation shocks and deliver only 2% returns if inflation stabilizes, that's a really bad combination, and the need for diversifiers becomes quite urgent.
So this has been really helpful, Rob. We certainly appreciate you packing a bunch of thoughts into a relatively quick-fire Q&A session. And thank you all for tuning in to these videos as well. Again, I'll note that we act as the tactical asset allocation sub-advisor on the PIMCO All Asset Funds. So again, if you're interested in diving deeper into how we're positioning those multi-asset portfolios to take advantage of these views, please don't hesitate to reach out, and we can schedule a deeper dive discussion with the appropriate PIMCO representative at your convenience. Thanks again for joining, and hope to catch you next time.
Thank you for your time.